Hello dear CA final students, welcome to day 2 of our case study scenario discussion. So today we'll be doing from question number 6 to 10, case scenario 6 to 10. So first we'll do this scenario 6. Joy Limited wishes to calculate tax base of its assets and defer tax as on 31st March 15, the balance sheet has been adjusted by current tax expense extracts of the assets part of the balance sheet as on 31st March 15 is given below. So this is a question on Ind AS 12. So definitely you will be having some understanding of the provisions of Ind AS 12. So here PPE 12 lakhs, product development cost 60,000, investment in subsidiary, there is trade investments, receivables, inventories and cash equivalents. Okay. Bad debt provision amounts to 1,30,000. Relates to two debtors. Debtor A 80,000, receivable originated in 12-13 and 10% provision was recognized in 13-14. Okay, so in the books this provision came in 80,000 and debtor B 50,000, receivable originated in 13-14 and provision was recognized in 14-15. Okay. Tax law allows deduction of 20% of provision for debtors overdue for more than 1 year, another 30% for debtors overdue for more than 2 years, and remaining 50% of debtors overdue for more than 3 years. So very good question I feel. So here trade receivables, what is the carrying value? Carrying value of trade receivables is 6,26,000. After deducting provision, carrying value is 6,26,000. What is the tax base? Tax base, is it 6,26,000? In the tax records, is the provision, is this debtors appearing as 6,26,000? No. 6,26,000 plus add back, you are adding what? That entire provision I added back, assuming it is not claimed as deduction. So 7,56,000. But we got some deduction. How much deduction you would have already claimed? This is 2 years provision. So 13-14 receivable originated in 12-13. Last year's receivable you created provision in 13-14. In 13-14 itself, tax law allows deduction of 20% of provision for debtors overdue for more than 1 year. So it is overdue for more than 1 year. So 13-14, current year is 14-15. 13-14 itself, in 13-14 itself, of this 80,000, a deduction of 20% would have claimed in the tax records. Yes or no? Yes, 16,000 it would have claimed in 13-14. And current year 14-15, on 80,000 you can claim a deduction of 30%, further 30%. So 24,000 deduction would have claimed. And with regard to debtor B originated in 13-14 and provision created in 14-15, current year only, which means it is overdue for more than 1 year. So on this 20,000 you can claim, or you would have claimed a deduction of 10,000, that 50,000 into 20%. So total deductions you got is 50,000. So in the tax records, this debtors will be appearing at 7,06,000. Are you clear? In the tax records, this debtors will be appearing at 7,06,000. Carrying value and tax base, carrying value is less. Carrying value of an asset is less than the tax base. You will create deferred tax asset. Deferred tax asset on a temporary difference of how much? 80,000. 80,000 into tax rate. Okay. Are you okay? If there is a doubt, please comment below. I'll clarify it. Now, Joy Limited accounts for inventory obsolescence provision. Joy Limited accounts for inventory obsolescence provision. Okay. New provision created in 14-15 is 10,800. So total provision. So already you would have created some provision plus 10,800 provision you created. So total provision has become 18,000. This provision is not tax deductible as it is a general provision. Oh. So which means your inventory is appearing at 3,04,000 in the books. So this 3,04,000 is after a provision of total 18,000. So carrying value is 3,04,000 and tax base will be 3,22,000. So again carrying value is less. So you should create deferred tax asset. So on 18,000 there is a deductible temporary difference on which you need to create deferred tax asset. 18,000 into that tax rate 32% given. So what are the questions, MCQs? With respect to point A, that is the first case, debtors. Determine tax base of trade receivables for the year 14-15. Tax base we have identified as 7,06,000. Option D, 7,06,000. With respect to point A, determine deferred tax on trade receivables. 7,06,000 minus 6,26,000, 80,000 into 32% is 25,600 DTA. 25,600 DTA. With respect to point B, determine tax base of inventories. Tax base of inventories is 3,22,000. With respect to point B, deferred tax on inventories 18,000 into 32%, 5,760 DTA. Option A. So here option D, 25,600 DTA, 3,22,560 DTA. Okay. Now case scenario 7. Joy Limited wishes to calculate again from Ind AS 12 tax base of liabilities. First we have done the asset side. Now liability side and deferred tax as on 31st March 15. The balance sheet has been adjusted by current tax expense. The extracts of equity and liability portions are given below. Okay. Share capital, accumulated profits, revaluation surplus, deferred income, liability for product warranty, deferred tax liability for the previous year, trade payables, healthcare benefits, current tax liability. So asset side is given. Government grants are not taxable. Government grants received in 14-15 is appearing in the balance sheet. So current year you received a government grant of 40,000. Government grants are not taxable. Okay. In 14-15, Joy Limited made a further provision for product warranty of 5,000 in 14-15. So here government grants, they have given government grants are not taxable. So definitely the tax base will be 0. Okay. In 14-15, Joy Limited made a further provision for product warranty of 5,000. Okay. Such provision for product warranty are not tax deductible until the claims, as like many provision. Always this is the rule for provisions. Only once it is paid or settled, you will get the tax provision. You will get the tax deduction. During the year 2014-15, warranty claims paid and settled is 6,200. Okay. So liability for product warranty is 16,000. Okay. Now, so this is the carrying value. What will be the tax base? Tax base of a liability related to expense. What is the tax base? Carrying value minus amount deductible in future. Entire amount is deductible in future upon payment or settlement. So it is 0. I can directly take it as 0. This is a liability related to expense. So what about a liability related to income? What is the rule? Carrying value. Tax base is equal to carrying value minus amount not taxable in future. Entire 40,000 is not taxable in future. So it is again 0. So otherwise this is the rule. Otherwise I can just think it will not come in the, it is not taxable means it will not come in the tax records. So I directly took it as 0. So here on 16,000 no deduction has claimed means 0. Okay. Now, during the year 14-15, Joy Limited introduced healthcare benefits for employees. Okay. The expenses are allowable as deduction in tax only when the benefits are paid in line with Ind AS 19. So you created a provision but only when it is paid you will get the deduction. DTA. Simple conceptual understanding. Future I'll get deduction. Here future I'll get deduction. So what are the questions? With respect to point A, determine the tax base of government grant. Nil. With respect to point A, deferred tax on government grant is, do you need to create DTA? You need to create DTL, or is it a deferred income? Government grant will not be taxable. So government grant will not be taxable. Government grant will not be taxable, deferred income. Which option? Appropriate option is deferred income. Government grant will not be taxable. Okay. Now, with respect to point B, determine the tax base of liability. Tax base of liability, nil. So here carrying value was 16,000. Tax base is 0. With respect to point B, deferred tax asset on 16,000 into 32 percentage. 5120. DTA 5120. Then healthcare benefits also, if the question is determine the temporary difference. So it was healthcare provision you created was 70,000. You will get deduction only upon actual provision. So tax base is 0. So temporary difference is 70,000. Why tax base is 0? You will get deduction only upon settlement means it is not there in the tax record. I may think like that. Or what I can do? Carrying value minus, this is an expense related liability. So amount that can be deducted in future. Deduction you can get for entire 70,000. So 0. So temporary difference is 70,000. So deferred tax asset we need to create. Deferred tax asset, let me check, 70,000 into 32%, 22,400. So option A, nil, tax base is 0. So deferred income, again nil, 5120, DTA. Temporary difference 70,000, option. Deferred tax asset 22,400. Then case scenario number 8. A Limited is a diversified business group operating in multiple business segments across different parts of the world. It maintains its books of accounts and publishes its annual consolidated financial statements under Ind AS. The central finance team has been working on closing the books of accounts and generating CFS. You are the finance controller and your assistants want your views on following transactions for finalization of financial statements. So you are finalizing a CFS where your assistants need your help. What is the doubt? B Limited is one of the subsidiaries of A Limited. Reported net income of 25 lakhs. Okay. Which equals to company's comprehensive income. Total, not OCI, not other comprehensive income, total profits, 25 lakhs. The company has no outstanding debt. Following is the information in the balance sheet. Current year, not current year and previous year. Equity share capital. Further issue of equity share capital. So current year there is issue of 40 lakhs. Retained earnings 100 has become 115 means current year retained profit is only 15. But you said profits earned is 25 lakhs. So there are only two appropriations. There can be transfer to reserve. But if there is transfer to reserve, then your reserves and surplus will not change. Your other equity element will not change. Because here shareholders equity is 300 and 355 means there is increase in 55 only. Share capital increase, 15 increase. There is no transfer to reserve. There are only two appropriations. One is transfer to reserve and the other one is dividend. So the company would have paid a dividend of 10 lakhs. I have to understand, I am a finance professional. So I know if the profits increase but retained profit is less means dividend, the company would have paid dividend. Okay, now A Limited also operates in the travel industry. So before that, let me read MCQ related to this. Okay. What cash flow should B Limited report as financing activity in the statement of cash flows? Issue of equity shares 240, no. Issue of equity shares 100, no. Issue of equity shares 140, no. See, if I don't get that feel that there will be a payment of dividend from the MCQ and options, I'll get definitely a hint. Oh, it is dividend. Issue of equity shares 40 lakhs and dividend paid is 10 lakhs. Okay. Now, with respect to point 2. So, point 2, let me read. A Limited also operates in the travel industry and it incurs cost unevenly through the financial year. Advertisement cost of 40 lakhs. Advertising cost of 40 lakhs were incurred on 1st July and staff bonus are paid at the year end based on sales. Staff bonus are expected to be around 400 lakhs. Of that, a sum of 60 lakhs would relate to the current 30th September. What? See, you already incurred 40 lakhs in the 1st July advertisement expense and total staff bonus will be 400. Of this 30th September, it is 60 lakhs. So, what is the question? With respect to point 2, what cost to be included in the entity's financial report for the quarter ended? IFR in days 34. So what is the rule? Recognize income and expense as and when it is earned or incurred. 40 lakhs and staff bonus 60. Because they are telling advertising expense incurred on 1st July. July, August, September is one quarter. July, August, September is one quarter. So July you incurred 40 lakhs means you recognize 40 lakhs as advertising expense. 60 lakhs relate for this period means 60 lakhs should come as staff bonus. Then question number 3 is an item of equipment X was acquired by A Limited on 1st April 2011 for 1 lakh having estimated useful life of 10 years with residual value of 0. Okay, so 1 lakh divided by 10 years, 10,000 should be the annual depreciation. The asset is depreciated on straight line basis. The asset was revalued to 1 lakh 4,000 on 31st March 2013. So which means book value was 1 lakh minus 2 years, 11, 12 and 12, 13 depreciated, 20,000. So 80,000 is the book value. This is revalued to 1 lakh 4,000. Okay, so what is the question? What will be the annual depreciation? So it should be 1 lakh 4,000. Remaining useful life is 8 years. Already 2 years depreciated. Remaining life is 8 years. So 1 lakh 4,000 divided by 8. 13,000 is the annual depreciation. And what is the amount of revaluation surplus that can be transferred to retained earnings? The revaluation surplus is 24,000 divided by 8, 3,000. If you are making a transfer, revaluation reserve in OCI to retained earnings, it is over the remaining life, that is 8 years, 3,000. What the standard says? Earlier depreciation, additional charge of depreciation or existing depreciation was 10,000. New depreciation is 13,000. So that 3,000. So 13 and 3 is the answer. 10, 13 and 3, 13 and 3. Option number C. Option C. With respect to point 4, point 4 we have not read. Point 4, 4 and 5. A Limited has spent 15 lakhs in developing new product during the year. Okay. The development cost incurred is recognized as intangible asset. We have tried this type of questions in Ind AS 12. For the purpose of computing taxable income, these expenses are allowable in full. Income tax, they have fully deducted 15 lakhs, but we are recognizing it as an asset. At the year end, company recognized impairment loss of 75,000 against the intangible asset. So here what is the question? With respect to point 4, what is the tax base? Tax base is nil, fully deducted. So tax base is nil. The company has issued preference shares that are redeemable at the option of the holder. So such preference shares are liability. 3 months before the 3 months before the end of the year, it was probable that the holders would require redemption. Okay, so it's a liability component. Which one of the following is appropriate classification for the annual payment of 12,000 to preference shareholders at the year end? Oh, do we need to recognize it as dividend? Payment to preference shareholders should be recognized as dividend, interest, Dividend 3 and interest 9. Dividend 9 and interest 3. If preference shares are treated as liability, then that preference dividend should be recognized as interest expense. Option B. Okay. So here, I hope that is okay. So here option D 40 and 10. Option D again, advertisement cost 60, 40 and 60. Option C 13 and 3. Tax base of intangible asset is nil and interest expense. If it is classified as liability, then the payment should be recognized as interest. Okay. Now case scenario number 9. U Limited is engaged in mining and many other industries and prepares its financial statements following Ind AS and follows April to March as their financial year. During the year 12-13, the company has faced some issues and for their solution seeks your professional advice. See, you're a professional. Come on, be serious. U Limited and F Limited are partners in a joint operation. Okay, engaged in the business. Is it Ind AS 111? In the business of mining precious metals. The entity uses jointly owned drilling plant in its operations. During the year 31st March 13, an inspection was conducted by the government authorities in the mining fields. The inspection authorities concluded that the adequate safety measures were not followed by the entity. As a consequence, a case was filed and a penalty of 50 crores has been demanded from U Limited. Okay. So we need to create provision. As a consequence, a case was filed and penalty of 50 crores has been demanded from U Limited. Now let's see. The legal counsel of the company has assessed the demand, and in their opinion, the appeals may not be useful and the appeal orders may be unfavorable to the joint arrangement. Confirm, you need to create provision. Out of 50 crores to be paid by U Limited, 30 crores will be reimbursed by F later as per the terms of joint arrangement. At the year end, actual reimbursement was not received from F. Okay, so here it is not basically Ind AS 111, it is Ind AS 37. This is a question on Ind AS 37. See what is given as per Ind AS 37 when we need to create a provision for which reimbursement will be received. Recognize reimbursement asset only if it is, what is the word should I write? Recognize reimbursement asset only if it is virtually certain to be received. If it is not virtually certain, recognize 50 crores as liability provision. With respect to joint operation engaged in the business of mining precious metals, how will the liability be disclosed? So it is provision for 50 crores and contingent asset 30 crores is such an option is not there. So the appropriate one is provision for 50 crores. U Limited has issued 10 lakhs, 9% cumulative preference shares. Okay. The company has arrears of 15 crores of preference dividend as on 31st March 13. Oh, they have not paid dividend. 15 crores dividend is cumulative and cumulative preference dividend payable. It includes current year arrears of 1.75 crores. The company did not declare any dividend for equity shareholders as well as preference shareholders. Further, U Limited has also issued certain optionally convertible debentures which are outstanding at the year end. Okay. What is the question? What is the amount of preference dividend to be reduced from profit or loss for the year for calculating basic EPS? As per Ind AS 33. If it is cumulative preference dividend, whether it is declared or not, deduct. So already previous year's arrears of preference dividend would have deducted from the previous year profits. You need to deduct a preference dividend of only current year 1.75. Because previous years would have deducted from that respective years, because that is the rule. You need to deduct if it is cumulative, whether declared or not, whether it is paid or not, it should be deducted. So they would have deducted only current year preference dividend payable should be deducted from the current year profits. Okay. Now, 3. Yes. On 1st January 2013, U Limited acquired 30% of shares of T Limited. Okay, associate. The investment was accounted for as an associate in U Limited CFS. Both U and T have an accounting year 31st March 2013. U Limited has no other investments in associates. Net profit for the year of T Limited's income statement 0.23 crores. It has declared and paid dividend of 0.1 crore. No other dividend were paid in this year. So if it is an associate, 30% of profit made should be added to the cost of investment, and 0.1 crore dividend declared, of which what is your share should be deducted from the carrying value of investment. So what is the question? What amount will be shown as an inflow in respect of earnings from associate in statement of cash flows? Cash inflow is only how much? That 0.1 into 30%, 0.03. Only 0.03 is inflow, right? Inflow is 0.03, dividend received. Will be shown as cash inflow. Okay, that let's find out now. That's it. So on 1st January 2013, U Limited also acquired 60% stake in S Limited. Cash consideration 1 crore to be paid immediately and 1.21 crore after 2 years. Okay, deferred consideration. The fair value of net assets of S Limited at acquisition date was 3 crore. The fair value of net assets of S Limited at the acquisition date was 3 crores. U Limited has calculated the cost of capital as 10%. NCI to be measured at proportionate net assets. So maybe goodwill or bargain purchase gain. So purchase consideration is 1 crore plus 1.21 crores after 2 years. So 1 divided by 1.1012. So 0.826 into 1.21. Let's take 1. So total purchase consideration is 2 crores. Add NCI 3 crores into 40%. 1.2 crores, 3.2 crores, and 3 is the net identifiable asset. So 0.2 crores will be 20 lakhs, will be goodwill. 3.2 versus 3, 20 lakhs goodwill. Now case scenario number 10. G Limited is a multinational company and prepares and presents its financial statements following Ind AS, and as its securities are listed on National Stock Exchange. G Limited has a number of business segments. Okay, a small question. H Limited is one of the recently acquired Indian subsidiary of G. It has to adopt Ind AS for the first time. Oh, first time adoption. Ind AS 101. For the first time as at 31st March 14 with 1st April 2012 as the date of transition. Okay. As at 31st March, value of raw material inventories was incorrectly reported due to an error. The amounts are significant. Oh. So as per the previous gap, you have recorded the inventories at a wrong figure. So at the time of first time adoption, if there is an error, that error is to be restated and you should show in that reconciliation. Now, G Limited is also engaged in software development. Now, G Limited is also engaged in software development. It enters into a contract with a customer to transfer a software license in the AS 115. Similar question is there. There is a contract with the customer to transfer a license, installation service, provide unspecified software updates and technical support for 2-year period. G Limited sells the license, installation service and technical support separately. The installation includes changing the web screen for each type of user. For example, marketing, inventory management, information technology. The installation service is routinely performed by other entities and does not significantly modify the software. The software remains functional without updates and technical support. This is exactly the same illustration in your Ind AS 115. How many performance obligations are there? Transfer of software license, installation, software updates, and technical support. Let's find out. Now, G Limited sells 20% interest in a wholly owned subsidiary K Limited to outside investors. So 20% you sold of a wholly owned subsidiary means partial disposal without loss of control for 100 lakhs. The carrying value of net assets 300 lakhs including goodwill 65 lakhs from the subsidiary. So it is cash debit, you got 100 lakhs. Partial loss of control with partial sale without loss of control means now in NCI. Now NCI should be recorded. Carrying value of net assets is 300 lakhs means 300 into 20%, 60 lakhs NCI will come. So there is a gain to be reported in P&L or other equity. Other equity, 40 lakhs. This is the accounting treatment. Let's find out the questions. MCQ. With respect to H Limited, state whether error should be reported in India's financial statements and how to rectify it. Error should be recognized. H Limited should report the impact of the error as a correction to statement of P&L for the current year. The correction should be reflected in the reconciliation. Yeah, it should be reflected in the reconciliation. The impact of correction is significant and it shall be amortized. No. The first Ind AS financial statements shall distinguish the correction of errors from change in accounting policies. Yeah, it is not change in accounting policy. It should be distinguished as a correction of error and reported as a part of reconciliation. Oh, here reconciliation as at 31st March 2013. No. On the date of transaction, there is a reconciliation. So option D. How many performance obligations? 4. What is the gain on sale? 40. So option D is on the date of transaction, 4 performance obligations and 40 lakhs. That's it, guys. So I'm not discussing the provisions here in detail. Then if I discuss the provisions, it becomes lengthy. That will fail the purpose of this revision. Do your best. Let's meet in the next video. Take care.